Hello and welcome to today's edition of Strategic Edge. I'm Juan Carlos Artigas, Global Head of Research for the World Gold Council, and I'm joined here today by Francisco Blanch, who leads global commodities, equity derivatives, and cross-asset quantitative strategies for Bank of America Global Research. He has more than 2 decades of experience in financial markets with a focus on commodities, and we're extremely happy to have him. Welcome, Francisco.
Thank you for having me, Juan Carlos. It's a pleasure to join you once again.
Excellent. So well, why don't we just jump right in? One of the key things that I think investors would want to know is, what do you think your clients are concerned on and focus on in this particular environment?
Sure, Juan Carlos. There's 2 main things that people are on the investment community are very worried about. One of them is obviously inflation and the implications it has for monetary policy, and in particular, how this interest rate cycle is going to play out over the course of the next few quarters. And then the second one, obviously, is the war between Russia and Ukraine and the potential impact this is going to have on global supply chains, not just at the moment where it's very visible and very clear, but also over the medium term. There's a lot of uncertainty as to how much we are going to lose in terms of Russian commodity supplies. Remember, Russia is the world's #1 commodity exporter by most accounts. So carving Russia out of the global markets is a very difficult thing to do. So there's a lot of potential implications, and our clients are very focused on understanding that part of the equation, the supply side of the equation, but also trying to understand how monetary policy tightening and the reduction in financial liquidity is going to impact the demand side of the equation. So those are the 2 primary concerns, I think, of most investors at the moment, Juan Carlos.
Yeah, and I would agree. I think that we're hearing very similar things. And do you think that they are looking at the commodities complex as a whole, or are they differentiating between the different subcomponents, whether it is energy or metals or gold?
Sure. So look, as I mentioned, Russia is a very, very large commodity producer. It's the #1 exporter of natural gas, #2 exporter of oil and petroleum products, #3 exporter of thermal coal, and it's also a very large exporter of many metals, including platinum, palladium, in particular, also nickel. And let's not forget about the importance that Russia, Ukraine in combination have for the world's wheat and agricultural markets. Plus, of course, Russia has been the largest buyer of gold across the central bank community for the last decade. So the impact of Russia in the world commodity markets is vast. So I think all our investor clients are trying to disentangle the various effects here that are playing out. So on the one hand, we are seeing supply side factors. Remember, Russia, as I mentioned, is very large in many markets. And in particular, I think the rising prices of natural gas, the rising prices of oil, people are also focused on the second round effects on other markets. For instance, the very rapid increases in energy prices have had a knockdown effect on European metals manufacturers, on European chemicals manufacturers in particular. Even European refiners are being swung around by this incredible shifts we're seeing in global supply demand dynamics. And then there is the other effects in terms of that we're seeing in terms of the impact on other markets like agriculture. The high energy prices impact fertilizer, but also it turns out Russia, Ukraine, and Belarus are big exporters of fertilizer, as well as natural gas, which is an input to fertilizer. So we're getting that as a pass-through effect on the supply side to the grains markets, and last but not least, there is supply itself, right? Which, as I mentioned, Russia and Ukraine are very large producers of the grains, and it's difficult to keep plantings going when there is military conflict around you, right? So all of those factors are important. And then perhaps another element I think a lot of people are very concerned about trying to understand a little better is how the shifts in Russian commodity supplies will impact global production chains and supply chains. In particular, the shipping rates, what's going on with those shipping rates, because obviously as we see sanctions being applied on Russia. Russia will have to find ways to reallocate its commodities to other markets, and that essentially makes the commodity trade a lot less efficient, Juan Carlos. And then perhaps the last bit here that I think a lot of people are concerned about is the sanctions that have been applied on the Russian central bank and the potential reaction that that may entail in terms of other banks, other central banks going out there and buying gold, given the fact that Russian reserves have been slashed in half as euro and dollar-based reserves were frozen as a result of the decision of Russia to invade Ukraine. So there's a lot of consequences here. And then there's perhaps also another consequence, which is the decision to sanction Russian individuals and take over some of the assets, which I think will also entail or also push some investors in some places of the world to maybe think about commodity alternatives to, let's say, a super yacht or a townhouse in London, right? So I think those are all factors that are currently in play and that investors are trying to get their heads around.
Yeah, it's extremely interesting. And one of the things that we've noticed and our analysis has shown is that, for example, as commodity prices increase, and usually in terms of periods of reflation, usually commodities more broadly are the ones that lead, and gold tends to lag. But once commodity prices start to impact inflation more broadly, and again, with the exacerbation of all the other factors that you just mentioned, it means that inflation starts to be kind of like top of mind for many investors. And this is when hedging becomes relevant, like hedging, some of those risks, whether it is directly from inflation or more geopolitics. And usually gold tends to catch up and oftentimes, at least based on historical analysis, outperform in the longer term. But if we kind of like move back a little bit the clock and we look at the early 2000s, investors experienced a commodity super cycle back then, and it was something that was talked about a lot. And do you believe that we are at the earliest stages of a new commodity super cycle, or would the impacts of from COVID and geopolitics have kind of like transient effects that they would eventually cool down, or do you think that they would be more systemic?
It seems to me at this point we're going from pandemics to wars to famines and just generally commodity shortages. And the question, I think, JC, is how we're going to solve those and whether the market is prepared to solve this. It's clear we have scarcity. We have low inventories of commodities in North America, in Europe, in Asia. We have low inventories in the grains. We have low inventories in energy. We have low inventories in metals. We have low inventories in gasoline, and we have low inventories in diesel, and we have low inventories in crude oil and in natural gas. Everywhere you look at, inventories are low, and demand is being reined in by the higher prices. Because remember, prices are just signals. I mean, all the high prices are telling you is that we just don't have the supplies, and we don't have the inventories either, and we don't have the spare capacity to ramp it up and meet that post-COVID or post-pandemic demand surge. Remember that China, at the moment, is still in lockdown, and we have oil well over $100 a barrel. So what's going to happen when China comes back from lockdown? And there's many cities at the moment in China that are suffering severe mobility restrictions, together with a big collapse in air traffic in China. Air traffic is down 75% at the moment, right, in China today with this energy prices on the screen. So I think there is still a lot of post-pandemic demand uplift to be had here. The problem is, as I mentioned, we don't have the supplies. So I think the question we should be asking ourselves is, can we solve through the natural means of the market the supply shortfall that we have, which is essentially requires investment in both energy and mining and agriculture to fill the void that we've left in the last couple of years due to underinvestment, but also the void that we're having right now because of the Russia crisis. Remember, 2020 wasn't just a demand collapse. It was also a big negative supply shock. We saw a big curtailment in CapEx across the board, in energy, in mining, across the board. Again, as people look to invest in the commodity complex, the issue they face is, as you very well know, is the ESG, environmental, social governance concerns. And I think if you look at the carbon footprint, obviously, of the energy sector is very high, and decarbonization, by definition, means that we have to keep hydrocarbons on the ground, right? So, and that's oil, and that's gas, and that's coal. But part of the problem is we haven't really invested enough on the mining side to create the lithium and the copper and the nickel that we need. And perhaps people may be surprised about this, but the best performing commodity this year ain't natural gas or oil or coal. It's actually lithium, because we are rushing to manufacture all these electric vehicles and that will enable us to transition to a carbon-free economy. But we haven't done it. So we haven't invested in for the last couple of years, and we haven't really invested in hydrocarbons for the last 7 or 8 because of the low prices, and now we can't really invest because of ESG. And then on the other hand, you have the mining sector, where we should be investing 2 to 3 times as much as what we're investing. We should go from 75, 80 billion a year to 160 billion a year. And somehow we can't seem to get our heads around that, because again, miners are not scoring particularly high on people's ESG tables, and for a reason, right? Because mining is not a very clean activity. But again, we've kind of gotten ourselves into a bit of a loop where it's really hard to get out of. So back to your question on the super cycle, are we going to see commodity prices rallying for a multiple number of years? It's possible, because if the Russia-Ukraine conflict doesn't end very soon, and we don't see some way to and we don't bring Russia back into international freight or commodity trading, we're going to have to replace a lot of Russia, and that's going to take a huge amount of investment. But also, we're going to have the hurdle of ESG. And in the meantime, we have all this demand, which is galloping on the back of the post-COVID recovery. So yes, this could last for a while, but I do envision, however, JC, a lot of volatility in the process. So that much I will say. I don't think it's going to be a smooth ride at all.